In 1987, Ronald Reagan's tax reform slammed the door on one of the biggest money moves high earners were using. Think doctors, think lawyers, think corporate executives, people with serious W-2 income who were buying real estate. But why? That's because it was helping them paper losses, which helped them crush their tax bills. Because real estate is one of the only assets where you can be winning in real life while looking like you are losing on paper. Most investments do not do that.
If your stock goes up, you pay taxes when you sell.
If your business makes profit, you pay taxes on the profit. Real estate is different. It has this strange ability to do two things at the same time. In real life, the property can be doing great. Rent coming in, mortgage getting paid down, equity building. But on paper, the tax return can show a loss. And in the mid-80s, high earners figured out how to aim that loss directly at their W-2 income. So the government decided to change the rules. That's where the passive activity loss rules come in. They decide whether your real estate losses actually help you this year, or whether they get locked in a box and carried forward for later. Here's the simplest way to think about it. The IRS basically split income into different buckets. Active income is money you earn because you worked. Passive income is money that can come in even when you are not actively doing much day to day. And the IRS decided that most rental real estate belongs in the passive bucket. So the rule became this: losses from passive activities cannot be used to wipe out active income. If the activity is classified as passive, that loss does not get to reach over and erase your W-2 paycheck. That is the wall Reagan's tax reform built. And this is why people get confused. They buy a normal long-term rental, they hear you can write everything off, they do their taxes, and nothing dramatic happens because the loss got trapped. It exists, but it is sitting in the passive bucket, waiting for passive income to offset or waiting to be used later. Now, to understand how people used real estate as a tax shield, we need to understand how a paper loss gets created in the first place. Real estate gives you normal deductions. Mortgage interest and property taxes, all of that matters. But none of it is the real weapon. The real weapon is depreciation. Depreciation is the IRS letting you write off the building over time because it wears out. Residential properties are typically depreciated over 27.5 years. Commercial is typically 39 years. And here's why depreciation is so powerful. You are not usually writing a check for depreciation. It is a paper deduction. So you can have a property that is cash flowing and still show a loss on the tax return. That's why doctors and lawyers love this pre-reform. They could keep earning more at work, but keep showing lower taxable income because their real estate paper losses were eating their W-2 income. Now there's something even better, and it's called accelerated depreciation. Normally, depreciation is slow, straight line, a little bit every year, but cost segregation lets you pull a big chunk forward. A cost segregation study breaks the property into components. Some parts are long life, like the main structure. Some parts are short life, like certain fixtures, flooring, appliances, and specific improvements. Those short life components can be depreciated faster, sometimes much faster. And tax provisions, like bonus depreciation or Section 179, depending on the facts, can allow even more front-loaded deductions on qualifying components. The result is the same: more depreciation up front, bigger paper loss. You can see how someone could be doing fine in real life, while the tax return is showing a massive loss on paper. The government saw high W-2 earners using real estate as a shelter and said, "We're done with this." So after 1986 and into the Reagan-era reforms, they tightened the classification. Rental real estate, by default, became passive, losses became limited, and the golden move of buy rentals, erase W-2 got shut down for the average high earner. But that didn't actually remove every path. They left many exceptions. They basically said, if real estate is truly your business, not just an investment on the side, then fine, you can treat it differently. And that's where the two big escape routes come in. One is real estate professional status. The other is the short-term rental loophole. Let's talk about the first one. Real estate professional status. People call it REPS. To qualify, the IRS wants to see that real estate is basically your main thing. You have to materially participate in a real property trade or business. You need at least 750 hours in the year in real estate activities, and you need more than half of your total working time to be real estate. That last part disqualifies most W-2 people immediately. If you work a full-time job, you might be working around 2,000 hours a year. So to claim REPS, you are basically telling the IRS, real estate is more important than my job. Some people can do that. And a very common setup is a spouse. If you file jointly, one spouse can qualify and the household can benefit. So a high-earning doctor could have a spouse who truly manages the rentals, meets the hours, and qualifies the couple. That is real. But for most high earners, REPS is a tough fit, which brings us to the strategy that exploded once Airbnb and VRBO took over: short-term rentals. Short-term rentals sound like a simple category, But in the tax code, they are a different world because the IRS recognizes something obvious. A long-term rental can be quiet. You place a tenant for 12 months, they pay rent, you fix things when they break, and most months you do not do much. A short-term rental is not quiet. People come in and out constantly. You coordinate cleaning, you handle messages, you adjust pricing, you manage reviews, you restock supplies. You deal with the property more like hospitality. So the IRS created a rule that basically admits if the average stay in the property is 7 days or less, it can qualify under the short-term rental rule. And when it qualifies, it is not treated the same way as a normal passive rental. That is the opening. But you still need the second piece: material participation. The IRS does not want you to buy an Airbnb, hire a manager to do everything, and then pretend you ran a business. They want you involved. One of the cleanest targets people aim for is this: at least 100 hours of work in the activity during the year, and you worked more than anyone else involved. Now remember the accelerated depreciation piece we talked about earlier, because this is where it starts to matter the most. When your activity qualifies to use losses against active income, cost segregation and front-loaded depreciation is what creates the big numbers. Now, if you want depreciation to hit hard, you need building value, because the IRS does not let you depreciate land. So if you buy a property where most of the purchase price is land, the depreciation engine is weaker. If you buy a property where most of the value is the building, the depreciation engine is stronger. This is why two properties at the same price can produce completely different tax outcomes. And this is also where local rules matter. Some markets have rent freezes, rent control, and restrictions that can squeeze long-term rentals. Short-term rentals can avoid some of those problems, but they have their own risk, regulation, city rules, licensing, and sometimes outright bans. So you are not just picking a property, you are picking a rule environment. Now zoom out for a second. Reagan's reforms made one thing clear: the government does not want the average W-2 person to casually erase their taxes with passive investments. That's the whole point of the passive activity loss rules, but they still reward real business activity. And if you want to take it one step further, you have strategies on the exit side too. A 1031 exchange can defer taxes when you sell by swapping into another property, if you follow the timelines and rules. And borrowing against equity can create cash without triggering taxable income, because loan proceeds are not income. That is why you hear people talk about buy, borrow, and hold for the long term. They are saying it because selling triggers tax events, while borrowing usually does not. So if your goal is taxes, you need a strategy for how you buy, how you operate, and how you exit.